Hi, everyone, and welcome. My name is Kayla Johnson, and I'm a financial planning associate here at Pathfinder Wealth Consulting. Today, we are going to be digging into the Setting Every Community Up for Retirement Enhancement, or SECURE Act. This act is the first major piece of retirement legislation since the 2006 Pension Protection Act. I'm sure you've read an article or two about it, as there have been lots floating around in the financial planning internet space. But today, we're going to focus on its major implications and their impact on your financial life. I doubt this will be as entertaining as Tiger King or anything else that you've been binging on Netflix lately, but I hope that you'll stick with me as I walk you through this important piece of retirement legislation. It was first introduced to the House in March of last year and passed through Congress and was signed into law on December 20th, 2019. Let's talk about who the SECURE Act will affect. It will affect those under age 70 and a half by the end of 2019 with money in a qualified retirement account. That includes accounts such as traditional IRAs, SEP IRAs, Simples, rollover IRAs, and most 401k and 403b plans. It will also impact people who are over age 70 and a half and are still working. It will impact non-spouse beneficiaries of qualified retirement accounts, including Roth IRAs. It will impact new parents. It can impact business owners who previously thought a company retirement plan would be too expensive, and it can also impact 5 to 9 plan owners. So let's look into the ways that these groups of people will be impacted. The first way is that RMD age has been pushed back from age 70 and a half to age 72. You have to take your RMD in the year that you turn age 72 and no later than April 1st of the calendar year after you turn age 72. So if you turn age 72 in December, you have to take your RMD within that year and no later than April 1st of the next year. Retirement funds can grow an extra year and a half, which can result in a significant boost to your overall retirement savings for many, many seniors. There is still the age 59 and a half early withdrawal penalty. So if you pull out money from a retirement account before age 59 and a half, there is still a tax for doing that. The government knows it's in your best interest to leave your money in your retirement account to grow so that it's available to you in your later years. Qualified charitable distributions, or QCDs, are still available when an IRA owner turns age 70 and a half, but you won't get the RMD satisfaction benefit until you turn age 72. The SECURE Act makes no changes to the date at which individuals may begin to use their IRAs and inherited IRAs to make QCDs. Thus, even though an individual turning 70 and a half in 2020 will not have to take an RMD for 2020, they can still use their IRA to make a QCD of up to $100,000 for the year. Beginning in the year that you turn age 72, any amount given to charity via a qualified charitable distribution will reduce the then necessary RMD as well. So let's look at an example. Carla regularly gives $3,000 to a charity that she loves. She turns age 70 and a half in 2020. She can give her regular financial contribution through her IRA as a QCD in 2020 and in 2021. Her $3,000 donation will not result in taxable income since it's given directly to the charity. But if she withdraws the $3,000 from her IRA, say in May, and doesn't give that money later, and doesn't give the money to the charity until December, it will increase her taxable income since the amount wasn't given directly to the charitable organization. So if she wants that, the tax benefit of giving her IRA money to a charity, then she has to give it directly to the charity. It can't come into her hands at all. Then in 2022, the year that Carla turns age 72 and must begin taking RMDs, she can reduce her RMD amount and thus her taxable income by giving that $3,000 to the charity of her choice. The rest of her RMD, she's free to blow on Michael Jordan paraphernalia since the release of the recent documentary, The Last Dance, has reignited her love for the greatest basketball player of all time. There is a small addendum to RMDs. The Coronavirus Aid, Relief, and Economic Security, or the CARES Act, that was passed at the end of March 2020 has waived RMDs for 2020 and for 2019 if you waited to take your 2019 RMD in 2020. If you have already taken your 2020 RMD, you can retract it within 60 days of taking it. However, most of our clients have already taken their 2020 RMD, so it makes no difference to most of you because we aim to stay at least 1 year ahead of all our retiree clients' needs. In other words, your 2020 RMD was likely in cash for the last year, so you might as well either have that cash in your hand or have it reinvested in an after-tax account and taking advantage of the recent cheaper stock prices that the market has given us. Back to the Secure Act. Another change that the Secure Act has brought on is that there is no longer an age limitation for IRA contributions. It used to be that if you were still working, you could no longer make any extra contributions to an IRA after you turned age 70 and a half, but now that has changed. The maximum age for allowable contributions to traditional IRAs, if you're still working, has been removed. Now you can continue to put money away in a traditional IRA if you work into your 70s and beyond. And as before, there are no age-based restrictions on contributions to a Roth IRA. Stretch-IRAs have been eliminated thanks to the Secure Act. There are no RMDs for non-spouse beneficiaries of retirement accounts. People who inherit retirement accounts from people other than their spouse must withdraw the full amount of the account within 10 years of inheriting. The entire IRA must be emptied by the end of the 10th year following the year of inheritance. Beneficiaries have some flexibility with the timing of distributions from the inherited accounts for maximum tax efficiency, but the entire account balance must be depleted by the 10th year. This causes a spike in a beneficiary's taxable income, and it's often in your peak earning years. So let's look at an example. Susan is 60 years old. She's 5 years away from retirement, and she earns $200,000. She is planning on delaying filing her Social Security benefit until age 70 to get the maximum amount. Her mom passes away, and Susan inherits her mother's traditional IRA. Since Susan's income for the first 5 years of her retirement from age 65 to age 70 is projected to be lower than her current taxable income of $200,000, Susan may elect to delay withdrawing any funds from her inherited IRA until age 65, and then withdraw a portion of her inherited IRA each year until she files for Social Security at age 70. That will ensure that she withdraws the full amount of her inherited IRA within 10 years after inheriting. So you have a lot of flexibility, but it just has to be within that 10-year window. There are 4 groups of beneficiaries to which the new 10-year rule does not apply. These beneficiaries are considered eligible designated beneficiaries. They include spouses, a beneficiary who is disabled or chronically ill, a beneficiary who is less than 10 years younger than the IRA owner, and minor children, but only until the minor children reach your state's age of majority, which is age 18 in most states. Eligible designated beneficiaries can take distributions over their life expectancy, and spousal beneficiaries can still engage in a spousal rollover as well. Minor children can stretch their IRA and take age-based RMDs as before until they reach the age of majority in their state, and then the 10-year rule kicks in. One thing to note about this rule is that it does not apply if a minor inherits an IRA from a grandparent or an aunt. Only if the IRA owner is their parent does this exception to the 10-year rule apply. For example, Chris is 40 years old and has a 5-year-old daughter, Lydia. The age of majority in their state is 18. Sadly, Chris dies and leaves his IRA to his 5-year-old daughter, Lydia. Lydia will have to take regular lifetime RMDs beginning the year after she inherits until she reaches age 18. But once she turns 18, the 10-year rule kicks in, requiring the entire inherited IRA to be fully depleted by the end of the year in which she turns 28. So she can take those smaller RMDs until she turns 18, and then it has to be depleted within 10 years. Another change has to do with distributions from retirement accounts. Each parent can make a penalty-free withdrawal of up to $5,000 for the birth or adoption of a child from qualified accounts within 1 year. This is known as a qualified birth of adoption distribution. The distribution must be taken during the 1-year period beginning on either the date of birth or the date of adoption of a child under age 18. The distribution can only be taken once the event has occurred. The rules don't even require that the distribution directly tie to qualifying expenses at all, merely that the distribution occurs after the birth or adoption. Fortunately, the distribution can be repaid over and above the standard contribution limits. Let's look at another example. Ryan and Sophie are good savers, and they contribute the maximum amount to their retirement accounts, $19,500 for this year, to each of their accounts. They adopt a child this year. They can both withdraw up to $5,000 from their retirement accounts starting that month, up to $10,000 total. They don't even have to spend that money on their new child. Then they can repay the $5,000 that they withdrew from each of their accounts, plus the standard contribution limit of $19,500 later. So in 2021, they decide to repay the amount that they withdrew and get back on track with saving, so they contribute $24,500 to each of their retirement accounts. Retirement plans have also been impacted by the Secure Act. Multiple employer plans, or MEPs, used to be closed, which were run by a sponsor that was a bona fide group, association, or organization, and members had to have a common interest or nexus. But now MEPs can be open. Members of open MEPs do not need to have a similar business connection or nexus between each other. Their businesses are no longer required to be similar. Open MEPs allow a single retirement plan for all members. This reduces the cost and complexity of retirement plans for small employers. And this goes into effect in 2021. There's also a change to the savings options that are available to employees. The default savings cap for automatic enrollment has been raised from 10% to 15%. So employers can automatically have their participants in retirement plans contribute up to 15% of their income to the retirement account. But of course, as always, plan participants can still opt out of the automatic enrollment and can still adjust their percentage contributions. Part-time workers can also participate in company retirement plans now. In the past, employers could exclude anyone who worked 1,000 hours in the last 12 months. But no, you cannot offer your coffee maker the option of enrolling in your retirement plan, though much of your productivity and success can likely be traced to it, or at least to mine. Also, small businesses can get up to a $5,000 tax credit for starting a new plan. There's an additional $500 credit for plans that add that automatic enrollment that we were talking about a minute ago. Employer-sponsored plans can now offer annuities inside their plans as either a distribution or an accumulation vehicle. And employers are protected from liability if the insurance company fails. There are 3 important pieces of information to keep in mind when you're talking about annuities in a retirement plan. Number 1, the annuity provider must have been selling annuities for at least 7 years and complied with all the state commissioners' rules like timely and complete paperwork filing and maintaining adequate reserves. Number 2, the employer must ensure the insurance company's ability to meet financial obligations. And number 3, the employer must select a reasonably priced provider, not necessarily the cheapest. Finally, participants can roll annuities inside 401ks into IRAs. In the past, participants who left a plan that held an annuity had to liquidate it in order to roll it over to a traditional IRA. But now participants can do an in-kind distribution of the qualified annuity if it's made within 90 days, and you avoid all surrender charges. The last change that we'll talk about pertains to 529 plans. 529 plan money can be used to repay up to $10,000 of student loans, including principal and/or interest. It's called a qualified education loan repayment, and it is treated as a qualified higher education expense. The $10,000 is a lifetime limit per person. The beneficiary can use up to that amount. However, an additional $10,000 may be distributed as a qualified education loan repayment for each of the 529 beneficiaries' siblings' student debt. So, for example, Taylor has finished school and has some money left over in her 529 plan, of which her uncle is the owner. Her uncle can use up to $10,000 to repay her student loans. Her brother, Matthew, is also carrying student loan debt. Their uncle can also use $10,000 of Taylor's 529 money for Matthew's student loans as well. That's a pretty great uncle. This change is retroactive to the beginning of 2019. So as a recap, the major elements of the Act include raising the minimum age for required minimum distributions from age 70.5 to 72, allowing workers to contribute to traditional IRAs after turning age 70.5 if they're still working, eliminating Stretch-IRAs by requiring non-spouse beneficiaries of inherited IRAs to withdraw and pay taxes on all distributions from all inherited accounts within 10 years of inheriting, allowing for distributions from retirement accounts for a new child through birth or adoption. It's now simpler and more attractive tax-wise for employers to start retirement plans at their companies, and it allows for the use of 529 money to repay student loans. So, what should you do based on all this information? If you are retired and age 70.5 or younger, you may want to discuss drawing down your IRA in a tax-efficient manner and or considering a Roth conversion. Drawing down your IRA before you start taking RMDs may be a good way to get money out of your IRA when you're in a lower tax bracket because your RMDs haven't started. This will lower your RMD at age 72. It will also lower the IRA's account value and thus the amount that your beneficiary must take out upon inheritance in that 10-year rule that we talked about earlier. Roth conversion may also be a viable option if you're in a low tax bracket or if you have significant tax losses that can offset the tax of the conversion. The goal of Roth conversions is to spread out the tax liability while you're in a low tax bracket to maximize the growth of the assets. You pay ordinary income tax on the portion converted, and Roths never require distributions. They grow tax-free, and they offer tax-free withdrawals if you keep the funds inside for 5 or more years. It's important to keep in mind that your Social Security taxes and your Medicare premiums may be affected by these decisions. Social Security taxes nor Medicare premiums will be impacted for another 2 years after these types of decisions are made, and you can always complete and submit Form SSA 44 to request a reduction of your Medicare premium if you can prove there was a life-changing event, such as retiring or getting married, divorced, or widowed. If you are age 70.5 and you're still working, consider contributing to a traditional IRA to continue to get the tax incentive and the additional savings for your retirement. You also may want to revisit the beneficiaries on all of your qualified accounts, since your beneficiary's future tax situation will be impacted by their inheritance. If you have a new baby, congratulations. Know that you can withdraw money from your retirement account within 1 year, but tread lightly as these kinds of decisions are almost always regretted. The taking out money part, not the having a baby part. Though after being stuck in a house with them for 2 months straight, you may feel otherwise. If you're a small business like Pathfinder, consider starting a retirement plan for your company. There are great tax incentives and savings opportunities for you and your employees. It has never been cheaper or easier. Finally, if you own a 529 plan and the beneficiary or any of their siblings have student debt, know that you can use up to $10,000 per person to pay down their student loans. These provisions are complex, and we recommend speaking with your financial planner and/or your CPA before making any decisions. Goes without saying, but these are strange times that we're living and working in. Our office is and has been fully operational, but it's not yet open to the public. So please, we are a phone call or an email away. And as always, please reach out to us with any questions or thoughts. We are here to guide you forward.